Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. As I've been mentioning all week, this is our week in review, year in preview series. Now let's go to our guest line and talk to Professor Jeremy Siegel, Russell E. Palmer, Professor of Finance at the Wharton School at the University of Pennsylvania. Professor Siegel is renowned globally for his research and teaching on the economy and personal finance. He is author of 2 of the top financial books of our generation, according to Barron's, Amazon, and Business Week. Stocks for the Long Run, now in its 4th edition, and the Future for Investors. Professor Siegel, welcome back to Market Wrap.
Thanks to be on, Mo.
Professor Siegel, let's start with the S&P 500. It is currently trading at an estimated PE of about 15.7. I'm going to talk about all the things, and as you know, thousands of people call me, and they say, Mo, this is the reason why I should not be in the market. And I'm going to give you all of those reasons today, and let's try and refute some of those. One of them, let's start with the PE ratios. 15.7, Dow's at 16.19, NASDAQ about 20 times. Comparing the current PE to historical valuations, do you feel that the U.S. equity market is undervalued, fairly valued, or overvalued?
I think it is undervalued.
Why?
Let me tell you why.
Okay.
Yes, when you look at 15, you say, well, isn't that the long-run average? And that is true. If you go back 120 years, averages around 15 or so. But I think there's 2 very important considerations that make this an undervalued market. Important consideration 1 is interest rates being so extremely low. There's just no competition. And my research shows that when interest rates are as low as they are now, you often get PE ratios in the 18 to 20 range rather than 15. So that is one important consideration. And a second important consideration is the fact that we're comparing earnings with maybe the next 12 months. We're not fully going to be out of the recession by any means. We have to remember that we had earnings on the S&P in excess of 90 before we went into this recession, and in the past we've always surpassed previous peaks in earnings. I don't know when it's going to come. I certainly don't think it's going to come in 2010, but 2011, 2012, there's a good chance. And then you're going to be looking at, you're going to be looking at earnings that are 80, 90, and very possibly 100 or more.
So we are looking at earnings that could continue to go up, and you're saying 100. But what about all of those people that are saying, look, we're in a secular bear market? If you go back to the 1800s, we've had these markets, and for 20 years the market goes down. We get 4, on average, recessions in between these, and we're in one of those things where we are going to come out of the recession now, but we are going to only muddle along. We're not going to have the huge growth, the snapback that we usually get coming out of recessions. We got 2.8 last quarter, maybe 4 this quarter. They're saying it's going to slow down next year once the Fed takes the punch bowl away. And when we see bear market bottoms and secular bears, it's around 7 PE, and that's what we've historically seen. What about all of those people?
Yeah, very well stated, Mo. First of all, let's talk about these 7 PEs. We saw these 7 PEs in the 70s and early 80s, but that was when you could turn around and put your money with the U.S. Treasury at 16% in a 10-year guaranteed bond, 13.5% on a 30-year non-callable Treasury bond. I mean, those were extraordinarily enticing, and there was not much money to have, much incentive to keep your money in the stock market. Take a look at what the options are today. You can go 10 years; it's 3.5%. If you want to go for the tips, and I do like tips in general, but their yields, I'm looking at the screen now, 1.3%. That's your yield after inflation. That's a fully taxable yield, as we know, so you got to keep it in your pension account. That's just not attractive when the historical return on equities has been 6 to 7% after inflation. So we're never going to get down to those single digits unless we get double-digit interest rates, and I think that's about the farthest thing on the horizon right now.
Professor, when we look at that, when we look at the 66 to 82, yes, I can say that interest rates were at those 13%. People say, why should I put my money in stocks when I can put it into treasuries and get a guaranteed return and not worry about the fluctuations? But if you look at 1929 to 49, we saw the PE go down to 9. We look at the 1901 to 1921 secular bear where the PE went to 5, and their interest rates at that time were not as high compared to where we are.
You're right, and I think here is where we have a very different economy, and this is important. Yes, the Fed messed up. We should have seen the risk that was building in these financial institutions.
Right.
But Bernanke is absolutely adamant in not repeating the mistakes of the 1930s, which we know the Fed made many of them, well documented. They let the entire banking system collapse. We had terrible deflation. Consumer prices and wages going down 30% in a period of 5 years from 1929 to 1934. Millions of bankruptcies. A third of all banks were out of business. There was no deposit insurance. We know how not to get there again, and that's what the Fed has done. They have flooded with liquidity to prevent the deflation that took place in the 30s and took place in previous bear markets. We were on the gold standard then. We didn't have any flexibility at supplying credit. That's one of the reasons we finally went off the gold standard. So we are in a different mode of economics post 1930, and I think those people who said don't be so certain, look what's happening, it looks like the 30s, I say yes, no, it started out that way, but it is definitely ending very different. You didn't have anywhere near this sort of recovery, the economy going up. You're right, actually, GDP now estimates for this fourth quarter are looking 4 to 4.5, and I'm one of the people that is very clear on the side that we're going to see faster than expected growth in 2010.
Where do you think the market is headed in 2010?
Right. I think we're going to have a good year.
Okay.
I think another 15% return on the market is very, very possible. It's always dangerous, as you know, short run because there's so much vacillation. But I think we're going to get better than expected recovery. Yes, interest rates will start creeping upward, but those profit revisions will be moving upward at the same time, and I think that will draw more people out of their shells, gain confidence in the economy and the market, and propel stock prices upward.
Professor Siegel, thank you again for being with us today and sharing your thoughts with us and giving us some ideas where you think the market is headed. Thank you again for being with us today on Market
A pleasure, Bo.
Everyone, that's all the time that we have today. We will be back tomorrow. Until then, good trading.